In this video, guys, we're going to look at 4 key fundamental analysis variables. Stay tuned. Hey traders, warm welcome to you. So if you're considering investing in stocks, the broad state of the economy is going to trump all. When we look at the price of a stock, we kind of have a pie chart here, and we've got literally the majority of it is down to the economy on the broad market. The broad market sentiment is good and the economy is good. The stock is going to do well. Then we kind of split it like this, and we almost have, sector here and the actual individual stock there. So in other words, the economy is the main thing that is moving your stocks that you're trading. Then afterwards, it's picking the right sector in that good, strong economy. Then after that, it's picking the right stock. We talk about top-down analysis and bottom-up analysis, but that's for something else. I want to talk today about some of the main 4 key variables that we look at when we're deciding if a country is a good place to buy a stock in, or if we're just trading in we're trading domestically, whether we want to stay in a country, whether we want to trade something else, whether we're looking for a stock for long-term holding. You get the idea. So bearing that in mind, how useful this kind of thing is. And also added, before we go into some depth on this, if we're just looking from a chart perspective of, hey, this is looking bullish, and don't forget, generally speaking, the stock market is slightly ahead of the curve. So it almost factors in a little bit more. So if you take this and you add a kind of longer term chart into the mix and you put them both together, it's going to give you a good idea of whether you get a good tick in this box, and then you can go and look for some stocks and sectors to invest. So with that being said, let's get going. Look at number 1, interest rate trends. Low interest rates or declining interest rates are preferred for companies. Why? Because it means they can borrow money cheaper, they can put it to work cheaper, they can expand, they can do all the things they need to do. Whereas in a high interest rate environment, it costs them more money, it costs them more to borrow that money, it becomes more considered. Maybe it doesn't even work financially if it's going to cost them 20% for that and it's going to only yield 10% on this over some number of years. They're just not going to do it. So they want an interest rate environment that's low, they haven't got to pay much to borrow the money, and they can expand. And that's good because they're going to earn more money. The bottom line is going to be bigger, the stocks will be more valuable. That's going to lift the market and the economy in general. Number 2, inflation trends. So steady inflation is good. In other words, the cost to buy the same thing the next day. So the cost of goods. There's a basket of goods, an inflation basket, and how much that costs over time. Slight inflation, i.e. costing a little bit more, is good. It's good for business because businesses know really, where they're going to be. They know how much they're going to have to spend. They can get themselves prepared for that kind of thing. If we have rampant inflation, that's no good, because rampant inflation means that people are having to spend way more to get the same kind of level of whatever they're doing, consumption or service that they had from the consumer perspective. And from a business perspective, if it's really expensive, then they just may not want to buy the thing because it's just getting out of reach for them. So we don't want super inflation. Of course, wages could catch up with that and it could kind of settle itself. But when you get inflation spikes, that's when things start to get unsettled. And then if we look at the other side of it and we look at deflation, deflation is just bad on everything because it doesn't encourage anyone to spend, because people are rewarded for not spending because things are getting cheaper and there's just no desire whatsoever to spend because, hey, I might as well just hold on to it because tomorrow it's going to be cheaper, tomorrow's going to be cheaper, next month it's going to be cheaper. A business won't want to invest in something that's going to cost them maybe, X% less in a year's time. There's just no incentive to invest. So inflation trend, a nice steady inflation trend is good. Okay, number 3, earnings. So earnings is pretty self-explanatory, how much a company is making. We've got earnings per share, we've got general earnings. We know the kind of thing that gets reported. And with businesses, we want to see good earnings growth, but more importantly, we want to see forecasted earnings. But don't forget, nobody really knows what the earnings are going to be. You can say it's forecasted, but it's a guess. Things might change. They're basing it on trends, they're basing it on this, they're basing it on that, and nobody knows. So you've got to be a bit cautious, and this is where the stock market really is kind of ahead of the curve. Generally speaking, stock market is multiple earnings cycles ahead. So when they start to see, hey, well, this is what we think the earnings are going to be in 4 quarters time, the stock price will usually reflect that. That's why we get these sharp moves when someone, or a company should I say, warns on earnings or changes earnings and then changes the forecast, because it's not that specific earnings that is most important, it's the forecast of where earnings could be. And you kind of might have seen these charts where the stock price is here and they say, okay, earnings is here, so we're going to forecast this kind of range of stock price depending on what happens, and they shade that in and say that's good, and they shade that in and say that's bad, and they give a range and say, well, that's where it's going to go. If you have a surprise in earnings that doesn't quite go the way it should do, all of a sudden this fan kind of looks like this, and it changes the kind of dynamic of where it potentially could go. So this is why forecasted earnings are so important, whether it's on the conference call and they're saying, hey, we're going to warn about future, whether it's economic guys doing a study analysis, even though they can't guarantee it, that's what people are generally looking for. So earnings, want good earnings growth, that's good for the market. Anything else surprises, obviously the downside, not so great. Could be argued that spikes the upside in earnings as well, got to be cautious of, because are they sustainable? Is it just a one-off, this kind of stuff. All right, number 4. GDP growth. GDP, gross domestic product. This has got to be sustainable. This is the general kind of power, if you like, of the economy. It needs to be nice, steady growth. In other words, steady, good companies growing, making money. The productivity of the whole country should be increasing steadily. Stagnating, no good. That's not what you want. You don't want to see bursts either. You want to see nice and steady. And that's the theme with all this, guys, is that we need steady growth on everything. Low rates so people can, businesses can borrow money, or at least not high interest rate environment. Steady inflation so that businesses can plan for the future. It's not spiking. It's definitely not deflating. Earnings, steady growth, improving, growing business, and GDP growth as well. As a whole, the whole economy is growing steadily. So that's what businesses like, good steady growth, nothing too alarming. If you get that, you tick that big box in your pie chart and you think, yep, you know what, that gives me a good backdrop to now look for my sector, I look for my stock. Anyway, guys, fundamental analysis variables, plenty more in there, but these are the main ones that dictate generally if people think that that country is a good place to invest. Take care. Bye-bye.